Welcome to the Risk Reversal Podcast. I am Dan Nathan. I am joined by a good friend named David Rosenberg. He is the founder and president of Rosenberg Research. David, Rosie, welcome back to the podcast.
Thanks for the invite. Always great to be with you, Dan.
You've been very generous, Rosie, over, I guess, nearly 5 years that Guy and I have been doing the podcast. I think you've been on probably close to 10 times. And, one of the things that I find most interesting about you, you spent a lot of time, decades down here as an economist, a strategist in New York City. And your last 10, is that correct? You've been up in Toronto, your homeland, running Rosenberg Research. And sometimes your perspective from being up there is very interesting, especially right now. It seems like this is probably the most contentious time the U.S. has had in a very long time with Canada on the trade front, but there's also, a lot of other palpitations that are coming from that. You've had some things to say about our policy, specifically on the trade front. You can read them on Rosenberg Research. I do mornings with Dave every morning. You guys should go check that out. We'll put the links in the show note. You have some open letters to President Trump on trade policy. You had a few things to say about his appearance on CNBC the other day. You have some thoughts on the firing of the head of the BLS. We're going to talk valuations. We're going to talk euphoria, a whole host of other things in the stock market here. So where do you want to start, Rosie? Because it's been a busy few weeks, despite the fact that we've had a couple different deadlines about trade deals. We haven't seen any trade deals. And I'm just curious, how this is factoring into your macro view, because right now there doesn't seem to be a lot of visibility when we're going to get a sense for what global tariff rates might end up being.
Well, lots to unpack there. And, this isn't necessarily a Canadian perspective. Rosenberg Research is headquartered in Toronto because that's my home. But we have 2,500 clients and they're spread across 40 countries. And in fact, 70% of our clients are in the States. So I don't come at it necessarily from a Canadian perspective. And in fact, despite all the angst and anxiety, so far Canada has been let off the hooks to some extent because of the carve-outs for what's covered under USMCA, which is, basically, almost everything. Not steel, not aluminum. And there's still obviously some elements of the auto sector that will feel the pinch. But, when you consider what's happening just this past week in India and in Switzerland, and several Asian countries, Canada is not actually faring that badly on a relative basis. I'm looking at this mostly from, you could say, a global perspective. I would say from a U.S. economic perspective. I guess that what really rankles me is that you hear a lot of assumptions coming out of not just President Trump, but all his cabinet and all his economic staff, that somehow these tariffs are not a tax increase, which in fact they have a similar impact to a tax increase because they're going to squeeze somebody in the United States. I'm just, I guess what really I'm getting tired about are the assumptions being made that are being espoused as being gospel or truth. One of them, for example, and I hear this from Scott Bessant and from others, is that that the foreign exporter is going to bear the complete brunt, which is not going to happen. And so far, they have taken part of the brunt, but not all of the brunt. You've got to ask yourself the question, that we're hearing that there's $150 billion of tariff revenues coming into Uncle Sam, and that's going to grow to at least $300 billion at an annual rate, if not more. Where does that money come from? It doesn't grow on trees. And it's not all going to come from foreign exporters cutting their prices to maintain their market share because they're going to go out of business. So who pays the duty? Do people sit back and say, geez, that's nice. I hear on CNBC or on Bloomberg or on Fox Business that we're just rolling in all this money into the U.S. Treasury to defray the big, beautiful bill. But where does the money come from? It doesn't grow on trees. That money is not coming from the foreigner. That money is either coming from the domestic importer, because it's the domestic importer of notice that pays the customs duty to Uncle Sam. And the question is, along this chain, who then bears the brunt? And so this is actually a de facto tax increase. The question is, how much gets shared by the wholesaler / importer, by the manufacturer, and then by the consumer. And then you have to look product by product to see what are the various price demand elasticities. But to make the claim that the consumer comes out of this without paying higher prices is fantasy. But that's what's being promulgated. And then again, I hear the Treasury Secretary, who is renowned as being the superstar of the cabinet and has a stellar reputation, come out and say that, well, this is just going to be a one-off. This is just going to be a one-off. Treat this as, he said, getting your driver's license fee. It's a one-off. But you see, I used to think it was going to be a one-off. But it's not going to be a one-off because it's not all happening at the same time. All these different countries are being treated totally differently. So you might have a deal with Japan and with the UK, but all of a sudden we don't know what's going to happen with the EU. We're still in talks with China, what's going to happen there. We just had these punitive tariffs slapped onto India and to Switzerland. We don't know the extent to which the changes are going to be made to the USMCA, which is coming up. So what's happening here is that it's not a one-off. It's a drip, drip, drip. And it's going to be ongoing. This is what the Fed is facing. The Fed would like to believe this is going to be a one-off price shock. But it's like what happened with COVID. COVID was not a one-off supply chain disruption. You know, all of a sudden, even after we got the vaccines, the next thing you know, China has one port city get 5 cases of COVID and they shut it down. And that had an ongoing implication for global supply chains. That's one of the reasons, among many others, why the inflation cycle lasted 18 months instead of 18 weeks. So this isn't a one-off. There's not a snowball's chance in hell that the consumer is not going to eat any of this at all. Now, I am of the view, by the way, that these price increases in the good side from the tariffs, and we haven't seen the whole thing play out yet, a lot of it will get eaten in margins because the labor market is weakening. We are seeing more slack emerge in the labor market that is going to compress nominal wages. And so we're left in a situation where if we get the inflation, the Fed can't cut rates. That's not very good. And then if we don't get the inflation with wages probably decelerating, we're going to get negative real income growth, and that's going to curtail consumer spending. You see, there is no good outcome here. I was very surprised that the president took on trade and tariffs as aggressively as he has. I thought it was going to be like it was in Trump 1.0, select trading partners, i.e. China, the true rip-off artist. It's not Canada. And by product. And of course, he's done that this time. But look at the size of these tariffs he's putting on. Now he's threatening humongous tariffs on semiconductors and on pharmaceuticals. The tariff rate, went to like over 2% during Trump 1.0. And now when you look at the Yale budget lab numbers, it's going to be over 18% as it stands right now, which is a $2,400 annual hit to household budgets. But you see, the thing is that we're still in the early chapters here and people are extrapolating. And what I hear, and this is the third fallacy, is that, well, there's been no serious inflation yet from the tariffs. So, it's the classic Alfred E. Newman, like, what me worry. But the thing is that businesses in the United States had a lot of time to prepare. So that's why the import numbers spun out of control and we had a massive inventory bulge. And so the corporate sector has been working through those lower cost inventories. Even with that, you're starting to see goods inflation creep up. It's nice that we're seeing service sector disinflation provide an antidote. And we'll see how those two forces collide. But we're in the early stages yet. We haven't seen all these tariffs kick in yet. He just at midnight today, slapped on those tariffs on roughly 90 different countries because we've just had all these reprieves. How can you say, on the one hand, Dan, how can you say, well, we haven't seen the inflation yet, but yet all we've seen are these reprieves. They haven't even started yet to the full extent. Now, I am not a big inflationist, but let me just tell you something. I'm always looking for non-corroborating evidence to my base case view, and I'm always looking over my shoulder as to where my blind spot is. So I'm a little nervous, to tell you the truth, that there's going to be more of an inflation squeeze on incomes, and not just personal incomes, but profits, than what's being priced in right now. I think the Fed will be cutting rates. It's hard to say how quickly and by how much. I don't think that Powell is going to succumb to pressure, but then again, we'll get a new chairperson in May, and then we'll see what the reaction function is, because the Fed chairman has one vote, the most powerful vote, but still just one vote. It'll be interesting to see how that all plays out. But given that we still have tariff-related inflation risk, that has not gone away at all. The economy has to weaken a whole heck of a lot to get the Fed to ease policy aggressively, keeping in mind that there's still, roughly 150 basis points away from its own estimate of where neutral is. So there's a long road to hoe to get there. And so in the meantime, what we also confront is a Fed policy that, at least for the next, call it 6 to 9 months, is still going to be, fairly tight.
Yeah. All right. Let's kind of go through a couple things really quickly here. So you mentioned Treasury Secretary Bessant, and he knows better than for this policy. He knows better than, the one-off sort of situation. And so I think, a lot of Trump's advisors find themselves in a situation where they're telling him things that he wants to hear, but they know better, right? And so that creates, obviously its own perils right there. And so as you think about these tariffs, and you think about just how he keeps slapping more on for those who are not coming to the table and creating frameworks, how do you bring them back? Like, how do you, I get it. You put a big threat on India, 100%, that it comes down to 50%. We saw what happened, right, with China a couple months ago. But here we are. It's not a trade deal, it's a truce. You hear folks from the administration on June 5th, and Gary Cohn's not even in the administration. He was in the first administration. He was on Fast Money with us. And earlier that day, there was talk of push outs and this. He kept calling it a trade deal. He kept on calling it a trade deal. And this is how the people, I think, talk to the president. So when you think about that sort of mentality within the administration, it makes it very hard to believe that if the economy does start to weaken the way you're suggesting it probably will in the back half of the year, the only thing that's going to happen out of the White House is more pressure on Fed Chair Powell to cut interest rates, right? And so right now, the CME Fed Watch tool has a 90% probability of a 25 basis point cut in September. What does rate cuts do? A year ago at this time, the Fed was concerned about the labor market, right? The Fed was concerned about a weakening economy. It feels pretty similar. They cut 50 basis points, and then they had 25 basis point cuts in the next couple of meetings. What would that do right now anyway, David? Because the inflation picture is very different, as you just laid out.
Well, look, they cut 50 in September, then went another 50, and they were concerned about the labor market at that point. The policy was excessively tight. But remember that was before the tariff file was just fed a boatload of steroids. People like to talk about, well, the Fed did this and the Fed did that last fall. I don't think the Fed, I can speak for myself, thought that this was going to be the dominant agenda. And it complicates the inflation outlook. The Fed is obviously a government entity, despite its independence or its perceived independence, but they are a bunch of risk managers. They have to manage risks. And the inflation risk is higher now than it was then. I think you just have your head in the sand if you think the inflation risk. And the Fed's primary concern with a 4.2% unemployment rate is whether the increase in prices, which they expect is going to happen, you see, they're not fooled by the fact that we haven't seen a more pernicious increase in inflation, because that's probably still lying ahead, because most of the tariffs haven't been implemented yet. And they're concerned with a fairly tight labor market, in their opinion. The labor market is showing some signs of cracks, but you can hardly say definitive signs of cracks from a supply-demand perspective. And that's the other thing that they're grappling with, is where's potential GDP growth right now, especially with the immigration outflows? Where is the unemployment rate benchmarked against the so-called natural rate of unemployment? And so the supply side of the economy, and primarily because of what's happening with immigration, that is also shifting. Well, so I got news for you, Dan. That this when people compare what the Fed was doing from September to December, it was in a completely different macro and risk environment. And I get frankly tired of when people say, well, look what the Fed did back then. Well, it was a different operating environment. And Powell's come out and said that definitively, that without the tariff file, they'd be cutting rates right now. They just don't buy into the White House view. Now, do you remember that the Fed is not really filled with politicians, but the White House is? And so the White House is going to give you a particular view on inflation. The Fed is giving you a different view, their view on inflation. They're the ones that control the monetary levers. I frankly don't quite understand why the president is pushing so hard for rate cuts prematurely in the face of tariff inflation risks. I'm sensitive to the view that this will get clogged up in the labor market, that companies may end up paying more of this cost than the consumer. Just to say the consumer's not going to pay anything, none of it shows up, is just, like I said, it's just ridiculous. And there's a lack of appreciation. It's interesting that the same people that are criticizing the Fed for taking its eye off the ball in 2021 and letting inflation fester, and criticizing the Fed for being slow to get ahead of the inflation curve, are the same ones complaining today that the Fed's not cutting interest rates into a different sort of potentially, not definitively, potentially inflationary shock from these tariffs. So what I'm saying is that who can blame the Fed for taking it slow? And I don't quite understand why the president, who really got elected, we could say, border issues, immigration issues, there are lots of issues. But the cost of living was the number one issue. It was inflation that killed, you want to call it, I'm not going to say Biden or Harris. The Democrats were crushed by the inflation. And while fiscal policy played a big role, so did the Fed. The Democrats got crushed just as Jimmy Carter did when he presided over inflation. Inflation is a killer for your election prospects. Bill Clinton figured that out back in the 1990s. And so I'm a little surprised that we'd want to actually roll the dice from a political level on inflation. Once again, you have the stock market testing the highs. You have credit spreads at almost their tightest levels on record. There's no signs, when you're taking a look at all the speculation out there, that there's any signs of any liquidity problems. The Fed doesn't know where the neutral rate really is. They just know how far we are. Their posted level of the neutral interest rate is roughly 3%, but there's a lot of people think it's a bit higher because the policy is so tight. How come nothing's broken? Now, we can talk, me and you, about the non-farm payroll number and even the household survey. The labor market situation is deteriorating. It's uncertain as to how much of that is demand related or supply related. And that's what the Fed's grappling with, is that maybe, just maybe, even though they talk about restrictive monetary policy, it might not be as restrictive as a lot of people think. And after all, if it was restrictive, what's the stock market doing what it's doing? Why are credit spreads doing what they're doing? And that's a big mystery. And yet at the same time, I can understand. I can understand. I remember back in December 2018 when Powell raised rates and the corporate bond market froze. And the stock market in December 2018 went down 20%. And at that December meeting, Powell basically said, oh, we're not done yet. But they were done. And I wrote a report saying, are these guys tone deaf? The corporate bond market has frozen up. Spreads have basically widened out into orbit. But where, outside of the White House, where is this clamoring to cut interest rates so soon? And I'm still a bond bull. I still think the Fed will be cutting rates well in the next year. But I do respect the fact that as an institution, it is a risk manager. And I think it is a little nutty, unless the economy really collapses, unless we start to get the sort of stock market we had in 2022, or the sort of stock market we had back in the spring. The Fed's supposed to cut rates in this sort of environment. It just boggles the mind. And I don't even understand why at the political level it's so important right now to cut rates. Because why, as the president, would you want to risk? How could he be so certain? How can Stephen Myron and how can Bessant and Lutnick be so convinced that there's no inflation risk from the tariffs? How can they be so sure about that? And so the Fed is definitely not sure. And it's not as if the Fed's not going to cut rates. But let me tell you, when it comes time to cut rates, given their inflation concern, the economy is going to be weakening appreciably. So if you're hoping for lower rates, be careful what you hope for. It's a combination of the law of unintended consequences, which, by the way, is what an 18% de facto tariff rate is going to impinge on the economy. So I think the Fed's going to cut rates. And it's less about really inflation, which is a lagging indicator anyways. You remember when oil prices hit, they touched $150 in the summer of 2008. And everybody was talking about inflation. Well, tell me, what was the next move by the Fed? Was not to raise rates. By the way, I'm pretty sure that Richard Fisher, who is president of the Dallas Fed, was the only one who voted for a rate hike, literally a month or two before Lehman collapsed because of the inflation risks from commodities. So, but the Fed cut rates into an inflation that didn't last, of course. But that's what we're talking about. I'm not saying, well, we have to have a financial collapse to get the Fed to cut. But what I'm saying is that the onus will have to be, in the circumstances, a much weaker economy than what we've seen to get the Fed to move off the sidelines.
So you just mentioned some of the economic advisors, including Treasury Secretary Bessant, Howard Lutnick, Marin. I think the answer, let's take Lutnick out of there because I'm not sure he knows much about economics, but let's just talk about cognitive dissonance. Like that's what's going on with the smartest economic minds in and around the president. But you had a lot to say about the firing of the BLS chief after they got really disappointing data on the July, obviously jobs front, but also the revisions. How does that lack of credibility now on this data? We're going to get a CPI, a PPI, a PCE. These are all in the next few weeks or so. And then we're going to have the August jobs data and the first Friday of September. What does this sort of questionable sort of act in the last week or so, like what sort of effect do you think that has on the data that's going to be coming out and the people who act on it?
I wrote a report, which of course you got a copy of the report, which was in defense of the BLS. And it was a fairly in-depth report on the revisions. The numbers always get revised. The reality is that over the past year, they've been revised down 3/4 of the time. This was a humongous revision indeed. But it's not the first time we've had revisions or downward revisions. It's the first time that the BLS commissioner has been fired, even though she has nothing to do with the data. She's just at the head of the organization and reports the data to the White House. So she did nothing wrong, in my opinion. But what can I say? The president is in need of a scapegoat when you have such a weak headline print for July and then these downward revisions. But it's not as if the household survey, like the household survey is a survey of households. I don't know, are the households, are they lying to the BLS when they said that there was a bigger job loss in the household survey than the weakness we had in the non-farm payroll survey? If the BLS really was a nefarious, insidious bunch, they would have futzed around with the birth-death model. But seasonally adjusted, the birth-death model added 80,000 jobs. That's the companion survey. If the BLS was really out to get the White House, they could have shown a negative because actually the survey itself was negative. It just got skewed up to 74,000 because of the birth-death model. Good grief. If there's one thing that the BLS could have futzed with, politically, massage, would have been the birth-death model. Why didn't they do that? So let me just say, look, I wrote about this. I thought, frankly, I'm going to do a public service. I sent it out to everybody, not just my client base, okay? Because the truth had to be heard. Maybe you want to say it's my truth, but I do believe that it is the truth as to how the data are calculated, why there are these large gaps. The reality is that since COVID, the response rates to the first survey are 57%. That means 43% of the businesses in the sample don't report on time. And by the time the second revision comes out, that response rate is 94%, and you have a much cleaner set of data. Maybe the BLS should just wait 3 months. Everybody wants the data right away. We need the data right away. Got to trade around the data right away. Do you know how difficult it must be? Has anybody asked themselves the question who are critical of the BLS? How difficult it must be to get you the number on August 1st for July for a $30 trillion complex economy with 130 million workers. They get you the numbers on August the 1st for July, and you expect that number is pristine? You don't think that number is going to get revised? What planet are you from? It's unbelievable. So the numbers so what's happening when you mix and match with the ADP data, it's as plain as the light of day that what's happening is the small business sector are laying off people now. Do you know that? The small business sector, the ones in the weeds of the economy, are laying people off. And they're the ones, because it's so cumbersome, that have delayed getting the data to the BLS on time. So the BLS is forced to actually do guesswork and imputations to get you that first number that you can trade off of. And then as the response rate goes from 57%, before COVID, it was over 80% on the first take. Now it's 57%. That's a big gap. But the 94% response rate, by the time you get the second estimate a few months later, that 94% response rate is exactly the same as where it was before COVID. Companies, especially small business, are not getting their updated staffing numbers to the BLS. But you know what? So then let's just basically, we got to find a blame game here. We got to find a blame game, because if the numbers were revised up 250,000, do you think we'd be talking about this right now? But they were revised. And then the July number was pretty bad. It wasn't negative, but like I said, people don't realize if they really wanted the futs, they would have done it with the birth-death model. It would have been very easy to do. That's the complicated part of this. That's the model-driven part of this, is that birth-death, which still is adding jobs right now. So I write this report, and I can't tell you the number of people, my clients and people from the outside, yelling at me, berating me for daring to support this ridiculous, antiquated, know-nothing government institution called the Bureau of Labor Statistics. And people tell me that they're know-nothings. They have antiquated models. They should deploy AI more. All this stuff, and how the president was right to fire this woman. This woman, the buck stops here. She has to take accountability. What did she do wrong? Except to say, when we filled in the gaps, because we're not getting the responses in time, it just so happens the companies filling in those gaps were laying off people. Why don't we blame them for laying off people? Why are you blaming me for reporting the data? And I can't tell you. I'd say the ratio of negative responses to my report to positive was like a 10 to 1. I was blown away. We just got a number today in Canada, okay? And employment in Canada is down like 40,000. That's like the U.S. reporting 400,000 decline in July employment. To which I said in my report, is the head of Statistics Canada going to have Carney cut off his head today? Is that going to happen? Because how can you tolerate having a bad number like that? That must be their survey methodology. Where is the AI capability at StatsCan? Let's see if that person gets fired, because that was a pretty horrible number. That was the worst number we got in the U.S. So, like I say, it just boggles the mind. But I don't want to get overly political, but it takes me back to Trump 1.0, when Kellyanne Conway famously said those famous 2 words. What 2 words? What 2 words did she say? Alternative facts.
Yeah.
So there we are.
So, Rosie, you just said something that's really interesting. I've known you since you were at Merrill Lynch, so I've known you for nearly 20 years. And I know you as the sort of economist who likes to deal with math, facts, and really no political bias. Like I remember you being critical of a lot of policy, and no matter what administration, you know what I mean, was in the White House, and you know who was in the Fed, that sort of thing. So I'm just curious, when you get that sort of response, I read that report and I'm like, you know, here's somebody speaking the truth here. It just, because it's not like what you had to say wasn't biased. You know what I mean? It was like, here's how this operates. You just explained it here. Do you think a lot of those negative responses were along party lines? Like was it political, the responses?
Yes, I believe that's the case. I believe that there's obviously this general distrust of the data. I would like to have seen what would happen in the counterfactual if those numbers were revised higher. What would have happened? Let's say that the data were revised up 250,000, which again would be an eye popper and could lead you to believe what is going on at the BLS. Would the BLS commissioner have been fired if it was a plus sign instead of a minus sign? Because that's also, you would think, pretty egregious.
Well, are we going to see that? Are we going to see that for August?
Look, the president is, He has the power to do all this stuff. Look, he's got the power to push through these tariff increases. I mean, you could argue that Congress gave up trade authority to the president, but stretching the limits on what's deemed to be emergency is, an eyebrow raiser. Here we have the U.S. International Court ruling against these tariffs, contravening the Emergency Powers Act. Then you got the federal appellate court now they've been doing the hearings and provided a delay just so that they could accumulate all the evidence. And then this probably goes to the Supreme Court before the end of the year. There's a prevailing belief that the Supreme Court will just basically find in favor of the president that nobody except the president can define what an emergency is. But you see, we don't know where the Supreme Court is going to reside on this, or if they will rule on it at all. And then there's this feeling, Donald Trump will be in office till 2028. All these announcements of $550 billion of investment here and $650 billion of investment there, they're just numbers. These countries are willing to say anything just so that they don't get hit with a 50% tariff. But those numbers have no meaning. Those investment inflow numbers have no meaning. They're probably not going to happen because it's not these countries. These countries are not going to print money or tax their population to then throw it into facilities in the United States. It'll be companies that do that. And these countries' governments are not going to be forcing their companies to be investing in the United States. That's a private sector matter. So you see, it's all basically camouflage and a ruse. And companies, if they feel that there is going to be a tariff wall for an extended period of time, maybe they'll be incentivized to bring that money over. However, when you think about the gestation period and how long you have to capitalize a capital spending project over 10 years, if you think that this is going to be like McKinley, that's what's very interesting is that Donald Trump, like the McKinley tariffs, they're only around for a few years. So I don't think there's going to be these big investment inflows. I think what's likely to happen, which you're seeing already, is a diversion of trade to the rest of the world. It's 100% true that the rest of the world loves the U.S. consumer base. They love the wealth of the United States, tap that. They love the low savings rate, the consumerism. But you're already starting to see, and you can see it in the export-import numbers, that there's a diversion of trade between other partners in the rest of the world. And so that's taking place. So I just think that when we come back to what's going on here, I'm trying to make sense of it. I try my best not to be political. I wrote a report last year before the election where we itemized meticulously all the economic platforms in the Trump campaign and the Harris campaign. And look, we said this is a no-brainer. The Trump plan is so far superior. And I got impaled by a lot of Democrat supporters, but I said, look, we're just giving a fair accounting. I'm not trying to be political. It doesn't matter. You're just walking on eggshells no matter what you do, but politics and economics and finance, they all mix together. Okay. You can't say politics and finance don't mix together when you have the president now allowing, private equity and crypto into 401k plans. They're all enmeshed. I get told all the time, don't get political. Don't get political. Well, I don't necessarily have a political bias. I was actually, if I could vote in the United States, I would have voted for Trump in November. I'm not anti-Trump, but I'm questioning his policies. I'm questioning why. I think is actually probably his best policy out of the whole fiscal thing, like no taxes on tips. Well, come on, what's next? Like free root beer in the water fountains? How does that boost productivity?
Well, Rosie,
how does that boost productivity? Let me just say, that's an election gimmick. However, the depreciation allowances on CapEx, that's meaty. I can get into that.
But that's like a one-time thing.
To promote capital spending from within, increase the supply side of the economy. You see, but the thing is that why would you then move 1 foot forward and then 1 foot back? Because the way the tariff and trade policy was being implemented, it's injected so much uncertainty that companies don't know the sort of environment on the trade and tariff side. People say, well, the United States only imports 11% of imports are GDP. That's not a small number in a $30 trillion economy. Oh, yeah, it's over $3 trillion.
Well,
So
and
you
throw
see, so
20% tax on that. I mean, like the
yeah,
20%
yeah.
tax on the 3 trillion imports
Well,
actually doubles
and
corporate
so
taxes.
nobody knows what the tariff rates are going to be with which country, who's going to be carved out, who's not going to be carved out, the whole piecemeal fashion, and all the reprieves and then non-reprieves, and then you don't know what's coming next. You can't plan. So you could have you could take all the depreciation allowances in the world, which is a great idea, and then you just basically douse it with cold water by injecting all this policy uncertainty. But you see, the thing is that we have to recognize is that this is not just about economics. Donald Trump, since the mid-'80s, has been a massive advocate for tariffs. He believes that the rest of the world is ripping off the United States and that nobody should be running trade surpluses with the United States. He doesn't believe anybody should be running trade surpluses with the United States. And the trade surplus is just a number. It's neither good nor bad. I went back decades and decades and found that the U.S. economy operates the same. The level of economic growth is the same when we run trade deficits as when we run trade surpluses. Because you run a trade deficit, you run a capital account surplus. You run a trade surplus, you run a capital account deficit. It's just how the balance of payments operates. It's neither good nor bad. And that's what's always caused me a little bit of problems, and especially with this team of mercantilists and protectionists. Now they call it, well, we used to be free traders in the Republican Party, now we're fair traders. Well, I could see in some cases in Europe, you can see in some cases in Japan, you could see obviously China's a big culprit, but it's really quite isolated. And these are just blanket tariffs. Like, what the hell is going on? Like, what's the number in Switzerland?
Well,
39%?
right. Yeah. So let me just ask you this, okay? And I know a lot of folks. There's two groups of people, in my opinion, as it relates to the economy, who voted for Trump. Is you kind of intimated earlier. It's the folks who are really feeling the bite, right, of inflation over the last, call it, 5 years or so. This is a mid to lower end consumer, right? And then on the higher end, you had a lot of folks that just felt exactly like you did. The economic policy or plan that the Trump campaign laid out was going to be better for the economy. Now, I think about the policies that have been enacted were exactly what they said they were going to do. So, like, for instance, he was talking about a massive tax cut primarily for corporations and high-end, earners, or whatever the hell you want to call them, the billionaire, millionaire class, that sort of thing. But then he was also talking about massive tariffs. Well, he did both of those, right? And so when you think about the tax cuts and then you think about what you just mentioned, the depreciation allowance, that's kind of a one-time thing. So if you think about the benefits right there, corporations are going to do exactly what they did in the first Trump administration. They're going to buy back their stock, right? So here we are with this tax plan. We basically are cutting the social safety net, giving corporates and the gazillionaire class this big tax cut. So we're borrowing trillions of dollars from the future, and they're just buying back stock. And look at the S&P at 6,400. We're going to talk about the stock market in a second here. So I'm frustrated with the fact of all these CEOs who are not speaking to it right now. They are frustrated, and you said this before. Where are they all? Tim Cook was in the White House giving Trump a block of gold the other day, talking about another $100 billion they're going to invest in U.S. manufacturing here. And the only headline that really supports that fact is $2.5 billion that they're investing with Corning, who makes the glass that goes on their iPhones in Kentucky that needs to be shipped to China and bolted together and then sent back here. It's a bunch of bullshit, okay? We know that they're not going to deploy $100 billion or hundreds of billions of dollars like they said. So my issue is that all these folks know better. Bessant knows better, Lutnick knows better, Tim Cook knows better, Jamie Dimon knows better, but they've all just kowtowed to this. And I just think I'll get off my soapbox in a second, but if we do go into a trade tariff-led recession, then it's really not the White House that I would blame. I would blame the folks that didn't say a fucking word this whole time. We're whistling past the graveyard of liberal democratic capitalism. I mean, think about it. The president was calling for the CEO of one of the most amazing American companies, not anymore, but if you go back 60 years, Intel, calling for the CEO of that company to resign because he's supposedly compromised because he's Chinese. Well, you know who's Taiwanese, who actually presides over the largest market cap company in the world and has been kowtowing to President Xi and President Trump, and he got export bans lifted from some of the most important technology we have seen in over 100 years. And we are putting it in the hands of our number one adversary, which will find its way into the defense and intelligence apparatus that is meant to, obviously, repel our democracy around the world. And so, to me, I just think we're so turned into a pretzel, and it goes back to, and I'll shut up, it goes back to a lot of folks who were willing to disregard everything we know about this man, everything we know about the policies that he wanted to implement. It was all in Project 2025, and here we are now. And so I just think that, and here we are 7 months into this administration, and it feels really bad.
I think people, generally speaking, Xi Jinping aside, are scared of the president. He instills fear, and I do believe there are a lot of Americans who like that, a lot. Look at what happened with Elon Musk as an example. Look how Zelensky got impaled. Now Zelensky, at that uncomfortable few minutes in the Oval Office, he really walked into his own grave. But those were pretty horrible few minutes. It's now the CEO of Intel is being pressured. He fires the BLS commissioner, and the only reason he hasn't fired Powell is because the Supreme Court, or Trump's lawyers, the White House lawyers, said that the Supreme Court will overrule him, or else Powell would have been fired by now. And then he takes Powell on this construction site, which is a cost overrun. Just for what purpose, really? You think the President of the United States has better things to do than to go visit the construction site of the Federal Reserve building with Powell, with really, in my opinion, and not everybody would agree, just embarrass him and humiliate him. Who wants to be that person? Who wants to draw that sort of negative attention, ridicule? Who wants for people to feel sorry for you? I felt sorry for Powell. I don't think Powell wants people to feel sorry for him. So it's that's the state of affairs that we're in. The only thing I would disagree with is that I did believe that the election was fought over border, immigration, cost of living. Trade and tariffs, when you look at the voter concern list on any poll, tariffs and trade were ranked 10th. And we all knew how we felt about tariffs.
It might have been ranked 10th, David, but if you go and you use ChatGPT, what policy platform and how frequently tariffs were spoken about in his rallies and some, I'll bet it's in the top 5.
I think it was more prevalent when he was running against Hillary, because that was just raw meat. Because of course, her and Bill they were pro free traders, and she wrote a book about it, which undermined her when she ran in the primaries against Barack Obama. So that was basically easy pickings for the president in the 2016 election. And the last one, it was. You remember when he got shot at, in Pennsylvania, when he was pointing to that chart on that big billboard, Dan, that wasn't a chart of tariff rates. That was a chart of border crossings. So that was front and center. And I would say tied was cost of living, because we had the inflation shock that seared in everybody's memories. So we all know how he feels about trade surpluses that other countries run, which is normal when the United States is a consumer-oriented economy. You're naturally going to, take in a lot of imports from other countries. I thought we would get Trump 2.0 would be like Trump 1.0. It would be targeted and selected. Did you really think, when you said that you weren't surprised, did you think that as it stands now, the average tariff rate would go from 2.5 to 18? Was 18 in anybody's radar screen? So he's taking this on like a dog with a bone, to an extent that I just don't quite understand, because tariffs, even if Bessant is right that it's one-off price, it's a one-off price increase. Well, that price increase isn't coming down. That price increase is an ongoing squeeze on personal incomes, unless you think we're going to get ongoing wage increases. But so I'm just saying, like, I'm watching this stuff as an economist. I don't know how the layperson reads because it sounds so credible. It's just a one-off. Don't worry about it. And yet, if when Powell came on to talk about transitory back in 2021, now everybody laughs at it. Oh, we all laugh at it with the benefit of hindsight. But to come on Fox News now and talk about it's transitory. Basically, when he says one price shock, transitory. But nobody's laughing. They're just shaking their head up and down. It must be the case. So it's funny that you get elected, and I guess maybe there's also the inept aspect of the Democratic Party to layer on. But cost of living was right up there. Inflation was right up there. And he campaigned on getting inflation down. Tariffs are not going to bring inflation down unless they generate the conditions for a contraction in aggregate demand, and then you'll get deflation for the wrong reasons, because you campaigned on prosperity and lower inflation. I don't quite understand. I really thought we were going to get a similar version of Trump 1.0 on the trade. So when you'd asked me at the beginning about, that I'm Canadian, I'm just looking at this actually from this is an overall, I guess, global, but also a U.S. perspective, right? Like I said, 70% of my clients are in the U.S. This is going to be a big ding. If it's not a big ding to you in the pocketbook, it's going to be a big ding to your employer, because somebody is going to bear the cost of this. And then just when I hear about the revenues being piled in, and people say, well, look, Dave, this is going to help pay down the deficit. Well, there's other ways to do it, because you want to cut taxes, but you're raising taxes. But you see, they won't call it a tax, right? And then actually I heard, I think it was Bessant yet again, who is the resident superstar in the cabinet, comparing all this to the VAT that American companies pay the VAT in Europe. That's got nothing to do with anything. That's got nothing to do with anything about the VAT, which is just a sales tax. This is a tariff. And who sends the check to the government is the importer of notice. The U.S. importer of notice is paying that check. And then who's going to pay for it down the line? That's the issue. And it's a no-win situation, because we get the inflation. That's going to be bad news for the markets. It's going to be bad news for the Fed, okay? Because we're going to get the inflation. But let's say we don't get the inflation. Somebody along the production line is seeing their margins get squeezed. What does that do? You get your margins squeezed. You got to cut expenses, which means labor, which means unemployment rate goes up. So this is a no-win situation. Everything else being couched that this is going to bring in billions and billions, billions of investment money in the United States is camouflage. It's a ruse. And the reason I say that is because a lot of businesses around the world that might look at this tariff wall as being attractive to jump over, I think a lot of them don't believe it's going to be here permanently. So I think they're just going to stay the course. And what's going to happen in between is, to avert the tariffs, is that the rest of the world, look what's happening in Germany right now. Germany is raising spending. You're going to find other countries cutting taxes. Look at what did Mark Carney do right away? He cut personal taxes. Other countries, maybe what they got to do. We didn't always call America Consumerica, okay? I think that started with the advent and proliferation of credit cards back in the 1980s. Consumerica. I think other countries, including Canada, may want to develop their own consumer base to draw off of. And then you're going to find what comes out of this, and the law of unintended consequences is that other countries will form other trading relationships over time. And that's when there's really no turning back from this. But the notion that, we don't even know how the Supreme Court is going to rule, and that's going to be later this year. Why would any company start sending in money, knowing that the Supreme Court can rule out all these tariffs to begin with? Why would you commit any capital? So it's going to be some tough going ahead, and it's going to be interesting to see how the Fed reacts, especially now that you have 2 to 3 rate cuts already priced in between now and the end of the year.
All right. We got to finish with the stock market here, because everything we just talked about, let's say for the last 45 minutes, the stock market, the S&P 500 doesn't care. We're within 1% of the all-time highs that we made a week ago. We have a 10-year yield that's at 4.28%. We have a VIX that's below 16. We have crude oil, which is below 65. We have, you just talked about corporate credit spreads. I mean, everything seems fantastic, right? But we just laid out a scenario that has the likelihood to end in stagflation. When I say end, or maybe begin in the not so distant future, you have a White House that's pressuring the Federal Reserve to lower interest rates. And you just explained why that is not the solve to this situation that we're in, especially given all the uncertainty. Let's talk about the stock market. Let's talk about where you'd want to be exposed. If not here in the U.S., are there some spots, internationally that look interesting to you?
Yeah, and that's a great question, because I'm viewed as being bearish, but because everybody is fixated on the S&P 500, which is in the top 5% valuations of all time, and it is the most concentrated stock market of all time. And it's hard to know. AI is real. The spending craze is ongoing, and it could last, as we saw with the internet in the mid to late 90s. It could last. It could last longer. These speculative bubbles can last quite a long time, and then you don't know. You have so much priced in. Maybe it happens. Maybe it doesn't. But the stock market, because of the concentration in growth, and growth by definition, growth is not real time. Value is real time. Growth are long duration stocks. The S&P 500 has become an incredibly long duration asset, which means there's a lot of assumptions behind whether those lofty future earnings estimates from the AI craze are going to play out or not. And I'll keep an open mind, but I like to invest with, and look, there's no such thing, Dan, as a sure thing, but I like to play the odds, and I like to invest where I see more tailwinds than headwinds. As far as the index is concerned, the S&P 500, it's too expensive. It's just too concentrated for my liking. So in the Rosie Macro Fund, so we have a model portfolio which actually covers FX, and it covers commodities, and it covers currencies, and it covers equities. So fixed income, equities, currencies, commodities. What am I bullish on? Because I'm actually bullish. I'm just not bullish on what everybody else is bullish on, but that's because I naturally have a contrarian streak, and I don't ever operate with a herd mentality. But, for years, we were bullish on Japan, and that worked great. And then we pivoted towards the Asian benchmark. So we still, you could say, still have Japan, but we like Asia. When we saw the tectonic shifts happening in Europe on fiscal policy, we went bullish on Europe, naked long with the euro exposure. That worked out great. And we are bullish in terms of sectors. Like, it's not as if I'm bearish on everything. We've been bullish on utilities. We've been bullish on the gold and silver miners. And we've been bullish on aerospace defense. They've worked out great. And then, of course, we have gold, and we have silver. We have uranium. We took a long position on the ridiculously cheap Japanese yen. That could give you 20% return right there. People don't think that currencies can make you an equity-like return. You can't do that in the equity market. Now, I don't know where Bitcoin is going to be going or how you treat Bitcoin. It could go to 5,000. It could go to 500,000. I don't know. It's like the NASDAQ 100 on steroids. But I look at the chart of the Japanese yen, and I look at every valuation metric, and I think that this one trade, in fact, we would probably right now go long yen, short euro. That if we're right on that, that's 30% right there, without taking equity risk. So we're always looking for opportunities. So bullish on precious metals. We're bullish on the yen. It's the most inexpensive, dirt cheap currency on the planet. And there's a few sectors that we like, not a lot in the U.S. That much is true. We still like the Treasury market as a balance in the portfolio, because we do believe, although it could be delayed, we're not sure, but we think that the economy is going to weaken precipitously. We do believe that inflation is going to come down, and that's more because the service sector side is going to disinflate faster than the tariff effect on goods. We don't think you'll make a killing in bonds, but I don't ever buy bonds to make a killing. I buy it as a diversifier in the portfolio, to limit the downside risks from the other parts of the portfolio that have a higher beta. It is a stabilizer and a ballast, no different than why we own gold, except for the fact that at least treasuries pay you some modicum of a coupon. And that's basically the story. That's what I'm bullish on. The Perma Bear probably has 6 or 7 great ideas from the long side for you.
Yeah. So early in the week, David, I often quote you on our podcast on Fast Money. I quoted you, the other night. You were talking a little bit about this concentration in the S&P 500. You're talking about the multiple expansion, and it's great stuff. So that's early mornings with Dave. This morning, you wrote, this is Friday when we're recording this, beyond the tech giants, corporate profits look mainly flat. It should be duly noted that when you strip out the mega cap tech stocks, earnings growth in the U.S. is really running very low at just 2.5% year over year, and the intense concentration in the broad market has yet to be resolved, with the top 10 stocks accounting for nearly 40% of the total market. All right, so people, you just said it. This could go on much longer. We've seen this sort of thing before. But how do you treat this concentration at this point? And it's kind of broadening out a little bit. And I'll use this example because I've said this a couple times. Palantir might be the dumbest stock. Now, not the stock, not the company, not their products, the dumbest way I've ever seen investors treat a trend. Now, if you think about the hyperscalers and the hundreds of billions of dollars and infrastructure build that they're doing and this and that, whatever, there have been some tentacles that have reached other parts of the technology, let's call it apparatus. Palantir is a software company that 2 years ago had a market cap of, 25 billion. Now it's at 445 billion. They're expected to have $4 billion in sales this year. Next year, $5.5 billion. The year after that, $7.5 billion. So it's growing fast off of a low base, but the market has assigned a valuation of 100 times sales this year and 80 times next. The sort of reacceleration you would need to ever justify that valuation in the next few years doesn't make a whole heck of a lot. It can't happen. Now, I'm not asking you to opine on Palantir specifically, but we're reaching a stage of this trade where investors, or this theme, that investors are searching so hard and they're indiscriminate on valuation. And that is a dangerous place to be on a market that you're talking about is so concentrated. We know where the earnings growth is coming from. We know the performance is coming on, and we also know where the valuations sit. And they can't go unabated, I guess my point is.
Well, look, let me just add to that, and I should tip my hat on the 2.5% to my good friend, our good friend, Dougie Cass. That it is still very much a lopsided market. Even though you could argue that it's broadened out in the past few months, it's still very much a lopsided market. And my concern is what's priced in. When you back out the valuations, the S&P 500, if you're buying the S&P 500 today, you're implicitly buying an asset class that is priced right now to deliver 11% compound annualized growth on earnings per share for the next 5 years. Now, when you look at where we are in the cycle, because that's not impossible to do when you're coming out of recession from a low level, where we are right now in the cycle, in the mature stage of the cycle, historically, the run rate on earnings growth from where we are today, historically, is 4%, not 11%. When you cycle adjust the situation, the market's priced for about triple the earnings growth that we normally see. Now, maybe this is not a normal situation because of AI. We know AI is going to create winners and losers. We know about the productivity aspect, but it's also going to have disruptions in the labor market. And as it dramatically reduces costs, well, think about when people talk about the benefits of AI reducing costs, somebody's cost, your cost is my revenue. My cost is your revenue. So there's just too much priced in. And I don't have to mark my book at 4 p.m. every day. I worked at Gluskin Sheff. I worked on the buy side. I worked at mutual fund. I know the pressure portfolio managers are under to perform every single day. It's more pressure than being an NHL hockey goalie. But what I'll say is that I only invest when I sense there's a tailwind, not a headwind. And when I look at the CAPE, the cyclically adjusted PE multiple, the CAPE is, I think, now north of 35. And 35 on a cyclically adjusted PE multiple is not a yellow flag, okay? It's a red flag. Because when you look over the next year, next 3 years, next 5 years, next 10 years, the total real return in the S&P 500 is negative across the board. why would I tell investors to invest in that sort of a landscape? I like to play off the front tees. I don't know about you. That's to me, that's just rational investing and patient investing. We've been saying all year long in the last year, there are better opportunities for long-only investors, and not everybody. Some people obviously just have a long S&P 500 mandate, in which case I would say I probably would be maximum cash right now, wherever that is. Some people have to be fully invested, to which I say, well, make sure, be mindful of your cyclicality and your beta in the portfolio and your Sharpe ratio. That's all I'm saying. Manage the risk. People just talk about returns. I talk to so many young people today in the business, they know nothing about managing risk. You see, I did not learn this at the Bank of Nova Scotia, Bank of Montreal, or Merrill Lynch about managing risk. When you sit out with the CIO and portfolio managers of a mutual fund every day for 12 years like I did as a market economist, you'll learn that the most successful investors over time are those that know how to manage risk. There's few people that appreciate that. I can tell you that right now, based on the old commentary I get from my dailies. I know people don't appreciate that. And people that tell me they're long-term investors are always looking at their watch. People who are long-term investors, they're always looking at their iPhone to see what the market's doing, because really to them, long-term is lunch next Friday. So it's interesting how people have shortened their time horizons. But guess what? I haven't. You can argue, well, Rosenberg's not shifted with the times. No, I basically have clients that have built their wealth. They rely on me to not screw it up for them. So I believe fundamentally in the preservation of capital and the preservation of cash flow. And I invest around top conviction themes. Top conviction themes is not blindly saying buy the S&P 500. It's much more methodical than that. And it doesn't mean I'm bearish on equities, because I'm not bearish on all equities. In fact, 50% of this Rosie Macro Fund, you'd be interested to know, when I tell people this, they run. You can run to the website and see, is he telling the truth? 50% of that fund, Dan, is in equities. It's just not in the S&P 500. Oh, ergo, he's a perma-bear. Because if he's not buying the S&P, what good is he? But anyway, we're just long other markets, and then there's parts. Look, the thing is that we are playing the AI trade differently. We've been long utilities for a couple of years now. Now they're getting pretty expensive, but dividend payouts, dividend yield is a core. I said be mindful of the beta, low beta, high Sharpe ratio, but also a running yield that's better that you can get at the front end of the curve. So utilities are a bond and drag, but also have growth characteristics. Aerospace defense is technology. It is technology in a different set of clothes, at better valuations and much better visibility, because defense budgets are going up everywhere. And in fact, they're going up in Japan and they're going up in Germany. Whoever would have thought? Do you think in your lifetime you would have thought we'd be embracing Germany, boosting its military expenditures? But that's the world that we're in. That's why we actually morph from just the U.S., just the S&P aerospace defense, to the global aerospace defense. But that is also, you look at the defense sector today, especially cyber. And it's not just the large caps, mid caps, small caps. They are very interesting. We've written many reports on this. We can't put everything in aerospace defense, but it's a core chunk of our holdings. But that is the proxy or surrogate for us not being in technology. We don't own technology, but we own the technology proxies. Defense aerospace has turned into a high-tech sector, but with better investment characteristics and tailwinds than we think the NASDAQ has.
By the way, Rosie, and I'm going to put it in the show notes, and I'm going to send it to you. A fellow Canadian who passed way too soon, Norm Macdonald, has a really funny military-ish joke about Germany, and I'm going to send it your way, because he used to say he was a little scared of Germany. You seem to be embracing their new appetite for defense spending. So listen, Rosie, good stuff. I can't tell you how much Guy and I appreciate, and our listeners, you coming back every quarter. And I just want to make one last point about your portfolio. You've been documenting that on our podcast. You've been documenting where you've been. So the folks who have to run and check out what's going on there, you've been talking about it. We know you to be bearish of S&P, the equity market here, but there's been many markets that you've been bullish on across asset classes. And I think it's a little bit of a mosaic that some of our listeners should go check out.
And a lot of people are modeling it. But that'll have a short shelf life because we are we're going to go live with this. We're going to launch this as an ETF in the next 6 to 9 months.
Awesome. Well, when you do, I hope you come back and you give us the 411 on that. David Rosenberg Research, really appreciate you being here again.
Thanks, Dan.